Then in part 3, assist your colleague by explaining what each of the ratios indicate, how ROIC differs from ROCE, and provide further commentary that can be used in the report to super optic. So please be careful, guys. There's 3 parts to the required over here. First, you're going to have to explain what each of the ratios indicate. Then you're going to have to explain how return on invested capital differs from return on capital employed. And then lastly, you're going to have to provide further commentary that can be used in the report to super optic. So please make sure that you answer all parts of the required. Now, when it comes to the discussion of ratio calculations, I've provided you with this framework. First, you need to interpret the ratio, and that comes directly from your lecture notes. But I'm also going to show you how to interpret the ratio by applying logic, because it's a lot easier to remember if you're able to apply logic rather than just memorizing a whole bunch of things from the lecture. So we'll interpret the ratio, or according to the framework, what you should do is first interpret the ratio, then compare it to a benchmark, then give possible reasons, and then finally, if there's any negative performance, you should discuss the impact of that negative performance and provide possible remedial action. Now, in this scenario over here, we don't really have any negative performance, so we won't be looking at discussing the impact of negative performance or remedial action. It's not relevant to this question. However, now you obviously can't just apply this framework, guys. You need to make sure that you actually answer the required. So how does this framework fit into the required? If we go back to the required, first you need to explain what each of the ratios indicates. So interpreting the ratio is explaining what that ratio indicates or what that ratio tells us. In addition to that, you can also give your junior colleague ideas of benchmarks that ratio can be compared to. So once you have the ratio calculation, what can we compare it to in order to determine whether we have positive or negative performance? Then, if you go back to the required, you need to explain how return on invested capital differs from return on capital employed. So obviously that doesn't fit into our framework anywhere, but we do need to look at that discussion separately. And then finally, you need to provide further commentary that can be used in the report to super optic. So if we have a look at our framework, if we actually compare the ratio to a benchmark, we can then say whether the ratio is positive or negative, so whether it indicates positive or negative performance. And that will obviously provide valuable information to super optic that can be included in the report. And in addition to that, we can try and discuss possible reasons. So obviously explaining to super optic the reason why the performance is either positive or negative. So there's a bit of an overlap over here. First, we are going to look at interpreting the ratio and explaining to your junior colleague what that ratio can be compared to. Then, ignoring the second part of the required, we'll look at that independently. Then, when we come to providing further commentary, we will actually compare the ratio to a benchmark so that we can say whether the performance is positive or negative. And in addition to that, we will provide possible reasons. Okay, so that's kind of how the framework fits into your discussion over here. Obviously, guys, you don't have to look at the framework like that. I just wanted to show you how the framework that I've provided you with in the lecture can be used in this instance, even though the required has been structured in a different way. You have the knowledge, guys. It's there. You know how to interpret the ratio. You know what the ratios mean. We've covered all of this in the lecture. You know how to compare to benchmarks in order to determine whether a ratio is positive or negative. You know that most likely the reason for positive or negative performance is going to come directly from the question. We have covered all of this in our lecture. The required has just been structured in a slightly different way, but you still apply the same logic. All right, so that's just what I wanted to show you over there. So what I want you guys to do is I want you to have the suggested solution open, because obviously there's a lot of discussion here. I'm not just going to write everything out. You guys can read what's on the suggested solution. Me writing that out doesn't help you. I want to go to the ratio calculations and look at those ratio calculations, and from there come up with the discussion. So I'm not going to look at the discussion. I'm going to cover the discussion with you. So make sure you have the discussion open and you can mark off those discussion points as I discuss this with you. Okay, so let's go to the actual ratio calculations. The first ratio that we need to discuss is return on invested capital, or ROIC. Now, if you look at what goes into the calculation, the interpretation comes from the ratio, guys. We are looking at the return that the company has been able to generate by using invested capital. And the return that we are looking at is net operating profit less adjusted taxes. Now, it's important to note, guys, that invested capital excludes non-operating assets. So it's total shareholders' equity plus interest-bearing debt minus non-operating assets. So we are looking at whether the company has effectively used capital invested in operating assets because non-operating assets have been excluded. So is SuperOptic using capital invested in operating assets effectively to generate operating profits? So we have a return of 16.68%, but we don't know whether that return is good or not unless we can compare it to something. So you need to explain to the junior consultant, what can they compare this ratio to? What can it be benchmarked to? And you know from our lecture, we can compare return on invested capital to the WACC of the company. And the logic is, guys, the WACC represents the minimum return that investors need in order to compensate them for the risk that they are exposed to. So the WACC is the minimum return that the company must achieve. So if we compare the actual return that they are achieving to the minimum return, which is the WACC, we can then determine whether the performance in the current year has been positive or negative. All right, so that deals with return on invested capital. I've interpreted the ratio, I've explained what this ratio tells us, and I've also told the junior consultant what this ratio can be benchmarked to in order to determine whether the performance is positive or negative. Let's do the same thing for all of the other ratios. So next we have return on equity. So in order to interpret the ratio, once again, look at what goes into the calculation. We are looking at a return, but the return in this case is profit attributable to equity holders, or in other words, net profit after tax. Now, guys, net profit after tax is profit after everybody else has been paid. Interest has been paid to debt providers, tax has been paid across to SARS, everybody else has been paid their money. So the net profit is the money that's available for distribution to ordinary shareholders. Now, the full amount is not necessarily going to be distributed. The company will pay some dividends, and whatever's not paid out as a dividend will be plowed back into the company, and hopefully as a result of that, the company will grow in the future and the shareholders will benefit from an increase in the share price. But this is the money that is available for distribution to ordinary shareholders. Some will be distributed in the form of a dividend. The rest is plowed back into the company so that the company can grow and the shareholders will benefit from an increase in the share price. So what we are comparing over here is whether the company is using shareholders' equity effectively to generate returns for those shareholders. So if we want to know what we should be benchmarking this to, if you go back to the information provided in the scenario, you were given the shareholders' required rate of return for SuperOptic. So the shareholders' required rate of return is the minimum return that shareholders want in order to compensate for the risk that they are exposed to. So the shareholders of SuperOptic want a return of at least 15% to compensate them for the risk that they are exposed to. We can compare the minimum return that they want to the actual return achieved in the current year in order to determine whether this indicates positive or negative performance. Then next, if we look at return on capital employed. With return on equity, we were focusing on profitability relating to shareholders' funds only. Debt was not taken into account. Now with return on capital employed, we are looking at capital employed. And capital employed includes both shareholders' funds and also interest-bearing debt. So we are now trying to calculate whether the company is using total capital, shareholders' funds, and interest-bearing debt, whether they are using total capital effectively to generate a return. Now, this ratio over here is probably going to give us a better indication of performance for SuperOptic because SuperOptic has debt in its capital structure. This is fine for a company that doesn't have any debt in its capital structure, or if we are just trying to focus on whether the company has been effective in generating a return for ordinary shareholders. But it's completely ignoring the return or whether they've been effective in generating a return for all capital providers, debt providers and equity providers. So obviously that's the benefit over here of return on capital employed. We are analyzing whether the company has effectively used total capital in order to generate returns. Now, guys, this ratio over here cannot be benchmarked to the WACC. If you think about it logically, you might want to benchmark this to the WACC because the WACC is the minimum return that your shareholders and your debt providers want to compensate them for risk. And this is the actual return that your shareholders and debt providers are getting. But the reason why we can't benchmark this to the WACC and instead we benchmark return on invested capital to the WACC is because, remember guys, WACC is after tax. So because WACC is after tax, we need to use profit after tax in the calculation. So that's why return on invested capital is benchmarked to the company's WACC, because WACC and return on invested capital are both after tax. On the other hand, return on capital employed, we use earnings before interest and tax in the calculation. So because this return here is before tax, you can't compare it to the WACC, which is the minimum return that investors want after tax. Okay, so that's the only reason why we don't benchmark that to the WACC. Then let's look at the last ratio over here, asset turnover. So once again, look at what goes into the calculation. This ratio indicates how effectively the company is using total assets to generate revenue. Obviously, the higher this is, the better, because then they are using the assets more effectively to generate revenue. Now, it's important to note, guys, that this ratio is going to vary significantly depending on the industry that a company operates in. So, for example, guys, obviously, if you have a very high asset base over here, if the asset base is very high, then your answer over here is going to be lower. So, for example, if we look at a company like aiii Campus, we don't have a lot of assets because we're in the service industry. We have a couple of laptops, we've got some recording equipment, but we don't have a lot of assets, especially if you compare us, for example, to a manufacturing company. A manufacturing company would have a lot of assets, a lot of machinery, etc. So, aiii Campus's asset turnover might be quite high because of the fact that our assets are low. So obviously the inverse here is also true. If assets are low, then your answer here is going to be quite high. So because aiii Campus doesn't have a lot of assets, we have quite a high asset turnover ratio. But you can't now go and compare that to a manufacturing company and say aiii Campus has performed better, because we haven't performed better. Obviously, the only reason why our ratio is higher is because we have less assets. Okay, so the ratio is also going to vary significantly from industry to industry. What's good for aiii Campus isn't necessarily good for a manufacturing company. And what's a good ratio for a manufacturing company is not a good ratio for a company like aiii Campus. So it will vary significantly depending on industries. Also, a limitation of this ratio is even if we are trying to compare two different companies that operate in exactly the same industry, so both of them are furniture manufacturers, for example. If the one company has newer assets, they will have a higher asset base because the assets haven't been depreciated a lot, and that will result in a lower asset turnover. On the other hand, if the other company has older assets and the assets have obviously been depreciated quite a bit, they will have a lower asset base resulting in a higher asset turnover. But that doesn't mean that the company with older assets has actually performed better than the company with newer assets. The only reason why the ratio is higher is because their asset base is lower. So because of this, it can be quite difficult to make comparisons between companies. All right, next, you need to explain how return on invested capital differs from return on capital employed. So if we go back to the information provided in the scenario, you'll remember that your junior colleague was quite confused because he calculated exactly the same answer for both of these ratios, because in both of the ratios, he used net profit for the year, and he called this invested capital and he called this capital employed. However, he divided by the book value of debt and equity in both instances. So he came back to exactly the same answer. However, if you look at the correct calculations now, you can obviously see that they're not the same and there are differences between the two. So firstly, you need to highlight that to your junior colleague. You need to explain. You can see from the correct calculations that these are not the same. So what are the differences between the two? Make sure that you actually answer the required. Firstly, guys, he incorrectly used net profit for the year in the calculation for return on capital employed, whereas it should be EBIT. It should be earnings before interest and tax. So that's based on earnings before interest and tax. On the other hand, return on invested capital is based on net operating profit less adjusted taxes. So this is after tax, this is before tax. That's the difference between the two. Go back to your calculations over here. You can actually see it clearly in the calculations. You can see when we are calculating return on capital employed, we are using EBIT, which is earnings before interest and tax. On the other hand, when we are calculating return on invested capital, there's EBIT, 19 million. It's the same 19 million that's being used over here. Except with return on invested capital, we deduct adjusted taxes. So this is after tax. So with return on invested capital, we are using net operating profit less adjusted taxes. This is after tax, whereas return on capital employed is earnings before interest and tax. So that's one difference between the two. Another difference between the two is with return on invested capital, we are dividing by invested capital, and it's important to note that invested capital excludes non-operating assets. So in other words, we are focusing on the capital that is actively circulating in the business and not capital that is sitting in investments somewhere. Capital or money that is actually circulating in the business. That's what invested capital is, because it excludes capital that is sitting somewhere else as an investment. On the other hand, with return on capital employed, we use total capital employed in the calculation. So in other words, total shareholder funds and interest-bearing debt. We don't exclude non-operating assets. Then finally, you need to provide further commentary that can be used in the report to SuperOptic. So now what we are going to do is actually compare the ratio calculations to a benchmark and say whether the performance is positive or negative, and also then provide potential reasons and look in the scenario for your reasons, guys. The reasons, 99% of the time, the reasons come directly from the scenario. So first we have return on invested capital, okay, which is 16.68%. And you'll remember we said because this is after tax, it can be benchmarked to the WACC. The WACC is the minimum return that your investors want after tax, and this is the actual return that the investors are getting after tax. So the actual return is 16.68%. The minimum return that they want, you were given the WACC, it's 12%. So this obviously indicates positive performance because SuperOptic has used invested capital effectively to generate a return. And by doing that, they've created value for their investors. Then for return on equity, remember, this is the actual return that ordinary shareholders are getting on their investment. So we can compare this to the minimum return that shareholders want on their investment, or in other words, the shareholders' required rate of return, which is 15%. So the shareholders' minimum return that they want to compensate them for risk is 15%. The actual return is 22.34%. So once again, this indicates positive performance because shareholder funds have been used effectively to create value for shareholders in the current year. Then for return on capital employed, remember we can't benchmark this to the WACC because the WACC is after tax and this is before tax. However, if you go back to the information provided in the scenario, you were told using the prior year audited financial statements, you correctly calculated return on capital employed to be 21.5%. So in the prior year, return on capital employed was 21.5%, and in the current year, it is 22.41%. So once again, this indicates positive performance because the ratio has improved from the prior year to the current year, indicating that capital has been used in a more effective manner in the current year. Then lastly, for asset turnover, the ratio is 1.84 times in the current year, and in the prior year, asset turnover was 1.2 times. So once again, this indicates positive performance because the ratio has improved from the prior year to the current year, and it indicates that assets are being used more effectively in the current year. So what is the potential reason, guys? All of these ratios have improved. Overall, Super Optic has performed very well in generating returns and using their assets effectively in the current year. What is the reason for this? Remember, 99% of the time, the reason comes from the scenario. You were told that they experienced significant growth in the current year as fiber infrastructure was rolled out in more areas. So obviously, as fiber was rolled out in more areas, more people will have access to fiber. So there was an increase in the number of potential customers looking for fiber optic internet data packages. So because the market size increased, Super Optic experienced significant growth, and that obviously resulted in increased revenue, which is why all of the ratios that we calculated indicate positive performance in the current year. All right, guys, so that then deals with everything in part A of the required.